Hi there. Every week at my Share Pickers Investment Club, we do a weekly webinar. It's on a Wednesday, and we look at one of the things we do on that is look at different companies' results. Okay, so interim results, financial results, also look at charts, stuff like that, and thoughts on the market. But yesterday, one of the companies we looked at was ASOS, who had their interim results out, and I did hold a little bit of ASOS. I was down in them, and I decided to sell the morning before the results came out, and I'm glad I did, because they dropped another sort of 18% on the results. But I was down on them anyway, taking a bit of a loss. But I'll show you on the chart why I sold. But also, it's worth looking at the fundamentals, because I don't think as yet the story isn't improving. Okay, so this is a spreadsheet I put them in. Okay, so we have two sets of things. This is final results. This is interim results, okay? And here's basically a summary, share price, market cap, enterprise value. And you can see the enterprise value is a lot larger than the market cap. In fact, let's increase this. And that's largely down to debt. Now, it's quite concerning, the debt, because if you look at it, we got a cash of 308 million, okay? Now, at the year end, they had 323 million. But, so, they haven't used that much cash. But look at the debt. It's got 740 million, okay? From 475, which is quite concerning when you're a loss-making company. You know, if you're making a profit, you can chip away at the debt. If you're making a loss, that's quite worrying. And so you can see operating cash flow minus 128 million, larger than last time. And if you look at the growth, I break this down into sort of my spreadsheets: growth, value, health, efficiency, and momentum. There's growth. No growth there. Operating profit down minus 6,000, and net profit growth down minus 1,500. Operating cash flow growth a little bit improved on last time. Value, if you're looking at price to book, it's not too bad. You know, the net assets are its value is 793 and the market cap is 4. But remember, when you're looking at companies that have, a value below the net assets, it's worth seeing if they're making a loss, because those assets will go down essentially if you're making a loss. So the value is a bit questionable. Health, also a little bit worrying. You've got here debt to operating profit there. You've got a decrease in 12 million of cash. Net debt, they've got 431 million. And also worth looking at, compared to the end year results, the margins weren't good there because they're loss making, of course. But now even the gross margin has gone down from 43 to 36. So it's not looking good. On a momentum front, by the way, I score every one of these, and there's a league table of scores, 2 for green, all that stuff. But momentum-wise, again, we've seen the share price drop. The reason why it's green here, the moving averages, is because it's yet to be reflected in the moving averages. They take longer to reflect, of course, the share price. But let's have a look then at the overall score here is 58, which is not huge. But let's have a look at forecasts. All right, now these are forecasts taken from Stockopedia, the next 2 years. Okay, and these are the margins plugged in, and also they've gone for they're going to have 2023. They're going to have 4.9 million of profit. That's what's penned in by the brokers, a consensus forecast, and then 49 million or close to 50 million for 22. Now using all these metrics, okay, you can come up with returns of this. So you expect returns for 2023 based on growth of 1% for 2023. This top line is 7% to 7% for 24-25, and margins of 5 for EBITDA, 4-3 thing. So it's an amalgamation of all that averages, and the multiples on this are 3 times EBITDA, 7 times profit before tax, and 10 times PE. Okay, so this is what you could expect if they achieve that. Some are saying that where they're burning cash, they may need to raise money. I don't know if that's true, but it's quite worrying how much the debt has gone up, in my mind. So yeah, but if they achieve those growth rates on those margins and on those multiples, then there's 665, 23, 47% up, 798, 76, and 857 is 90% up. In my mind, there's probably better risk rewards out there than this. It's now become quite risky because of the debt. Why did I sell? So like I said, one of the darlings of the stock market, they've got 60 quid. It's come down to a low of so where's the low? We're not far off the low now, are we? Here we are at the low. So that's not a good sign. But this is why I sold essentially. If you notice here, I sort of bought a thing. Did I buy in the breakout here somewhere up here? But if you notice this breakout, okay, and it's touched this before, and now it's become support, and it broke through down below that, and I sold in the morning here, just below £7, and like I said, it dropped the next day by 23%, and now it's down by another 7.55% today. So it may have a technical bounce because as yet, if you look at the RSI, it's quite oversold. But personally, I'd wait for an uptrend to happen. Like I said, the RSI is now at 20, which is very oversold. And when it's done this before, has it been this low? I think it's been this low for a long time, hasn't it? Maybe it has bounced. But in my mind, fundamentally, it's a bit questionable. Will they improve margins? That's what they need to do. They need to improve margins, essentially. And I understand they're doing that, but they're taking a lot of costs out. And maybe up the growth a bit. But at the moment, you may get a technical trade, but fundamentally, I remain to be convinced if they can turn this round and get anywhere near their previous glory. And like I said, even if they do quite wellish, there's only about 90% upside on those margins and those multiples. Hope that helps.